Okay,
let me just
makes sense.
So basically, we're just going to talk about the keywords and the key things in which you need to understand the markets. Like, do you have any background information based on trading?
No, I don't.
Okay, still no problem. So we're gonna look at the basics like supply and demand, which is seeing where the supply is, seeing what is, and then just gonna look into liquidity. We're also gonna look into the structure of the market. And then, so these are just the three basic things you need to know. And then in terms of like terminology and all of that, so we have BOS, which stands for break of structure. So you will see us use a lot of BOSs. So I'll also let you know what a BOS also implies. So we also see BOT, which is break of trend. See a lot of break of trend. So you also see IPA, which is impulse price action. And also price action on its own is also, let me just put PA price action. Yeah, so for now I want us to just focus on these here. So supply and demand is basically what governs the market. There's no market without the supply or the demand. Knowing what the supply or the demand is, because when it comes to the market, supply always meets the demand, and then the demand is pushed to also meet the supply. So it's vice versa. So one goes to the other and the other goes to the other. You see that? So in terms of supply and demand, you must know that there's two different types of supply and demand. So there's a discount demand, and then there's a supply, and then there's a supply demand. Let me also add Fibonacci, the levels. Yeah, so there's a premium demand, and then there's a discounted demand. So if we look at this hourly setup here on NASDAQ, this will basically, so these 2 points here would be seen as our premium supply. This will be our premium supply, and that will basically be our demand.
You're cutting, bro.
Am I cutting? Can you hear me?
Yeah, the audio is cutting a bit. I wanted to
Come again?
ask.
Yeah, you were asking?
You said for the of supply and demand, the count.
Yo, my G, I'm sorry, you were cutting a bit. You mind repeating that? Bro, you mind repeating that? Luco. Luco. Damn. Who knows? honestly taking a vow to be a religious person. It's hard like this here on earth. And then you mentioned, yo, dog convey the dog. Bro. Like letsatsi le ke feeling ke telang ngapa dog, ke lang bola nja. Makala di hele mfito. Ge do na le mo mfito every single fucking second time. Yo convey the hell dog. Bro, Mkolo, can you hear the man?
Sorry about that service, bro. Network is having issues there.
Oh, you back?
Yeah, I'm back, bro. Sorry about that. My network was giving me issues, but I got it
Yeah.
sorted now.
Alright, don't worry about it, bro. Even me and Gio were trying to have a call, bro. Like, yo, the network was so,
Hey,
yo,
bro.
it's pissing us off, dog. Like, yeah, but let's just keep pushing. Let's just keep pushing. So, you were saying your question was?
Oh yeah, I was asking about the two types of supply and demand that you were explaining about. Could you please repeat that, bro?
Okay, yeah. So the two types of supply and demand, basically, is your premium supply or your premium demand, which is basically the highest
Okay.
price or the lowest price, either on demand or supply. And then you have your discount, discount supply or discount demand, which is where the market will
Okay.
either give off the trade at a discounted point or at a discounted price, or it
Okay.
will just take it from the premium. If it's anywhere below the premium and the discount, it's usually a sell-off. It's what we call a sell-off or
Okay.
buy on, you see. So yeah, those are the two types. So I'll show you how you also identify with the discount and the premium and the discount is. So one thing to know about the difference between the discount and the premium is that they are usually not more than 20% difference. It can never really be more than 20% difference between the premium and the discount. So if they give you, even if a shop is maybe giving you something at discount, they usually just took out like not more than 20% of whatever they're saying is at a difference. So yeah, those are the two types. Let me just
All right.
discount. Yeah, so you should know that certain trades show themselves off at the discount or the premium. It will also depend on the number of orders or liquidity that is within the market.
Okay.
Okay, so we usually we strive to take trades where it's either between the supply or the demand, you see. So in order for us to see if the trade is looking nice or it's profitable, we first have to discuss like, is it at the discount or the supply? You know, if it's not between any of those levels, it's not really a safe trade to take, you see, because if anything can reverse on you, you know, or you're probably in the middle of a trade that is happening, you know. So which basically brings us to our second thing, which is trend line. You see that? So actually, let me just clear off a few of these things so that you know, we can have a better visuals, because yeah, my charts are always just cluttered with a lot of things. So what we have to look at is the trend line, you see. So you go on a lot of these YouTube videos. Well, when I went on YouTube videos, they will basically, they will tell you that you must trade the trend, right? Which is what is most common. Yeah, you've also heard that, right?
Yeah.
Yeah, you must trade the trend and all of that. That is 100% bullshit. I don't want to lie. So at the Gold Sniper community, we don't trade the trend because the trend line is basically what we call, is like bread on the floor, or it's like bait. You see, trend line is bait. Trend line is for the suckers. Yeah, trend line is usually for the people that don't know how to trade, you know. So just like me, when I started off listening to all these guys telling me I must trade the trend, and they were all just talking bullshit. So another thing you should know about these YouTube traders and all these YouTube guys is that some of these brokers and institutions actually pay them to give off false information. You see that? So that more people can keep losing more money on the market, you see. Because if everybody's trading the trend and everybody's losing. So let me tell you why. So the trend is basically set there to bring everybody into the game, you know, because everybody likes following trends and following what the trend is. You know, so if the markets are showing you a trend, they're trying to attract you to the market, to the ball game for you to enter, because that's what everybody likes. Everybody likes a trend, you see. So second of all, a trend is basically a liquidity booster. You know, it's a liquidity booster. The trend line is what brings money into the market. You see that? Because everybody trades the trend, everybody is invested in. You see that? So if you look at any broker, if you look at any broker, they'll tell you that 70% of traders lose capital. You see, and that's true. 70% of the traders are trading the trend line, and so in order for you to trade a trend, you honestly have to have a lot of money in your account, because all of the up and downs, you know, might chop you out and stuff like that. So we avoid trading the trend, but it's important to notice where the trend is, you know, because once you notice where the trend is, you can notice where basically the money is, or which side the money is coming into the market on. So in this instance, this trend is going up. So there's a lot of liquidity on the downside of the trend. You see that there's a lot of liquidity on the downside. So what we aim to do as the gold snipers, we are trend breakers. You see, we break the trend. You see, we don't follow the trend. We are the guys that break the trend. And once you break the trend, you find yourself in a position to make as much liquidity as there is on the market. So I'm looking to.
So the I just wanted to also the liquidity is the opposite of what the trend line is showing you.
Yeah, that's where the liquidity is being generated at. You see. So there's still also liquidity on the upside, which is why it's trending to go up, because it's also trying to collect that liquidity. But simultaneously, it's also generating more liquidity on this side, you see. So as you can see, this move here is what we call an IPA, which is an impulse price action. This price action here, it was a very fast and swift movement. So this was breaking this trend here. You see that?
Okay. Yeah, makes sense. Makes sense.
Yeah, it was meant to break this trend. And since the market rose from this level here, you see, it has left a huge gap of liquidity. And then what it's doing here was basically just changing character, you know, which is changing where it's trying to go. So the market doesn't just go up and go down. It will go up and then it will change the character and then go down. You see that? So what it was doing in this section here was basically just changing the character of this movement here, of this IPA. You see? So once it came up, the retail traders started coming in. You see, so a lot of options were being taken in and all of that. So as soon as there was enough liquidity with this trend here, they came, they broke this trend, and then they came down to here. So this is, you see, it's supply and demand as well. So this is where we are getting we're verifying our supply and demand right here.
So now for this specific trade, when would it be the most advisable to buy and sell? Just studying what's happened here.
Okay, so in this, because I remember we caught this trade here. This trade we caught. I remember we caught this trade. We caught it again here. We caught it again here, and so see here, there was a homie of mine. He told me he bought NAS here. No, I think it was here. He bought NAS here, and then he kept going. So when I looked into the market, the price was around about here, if I'm not lying. It was around about there. So at that point, what I would deduce is that as soon as the price goes close to this level, you see where this order block is, close to this level. So basically the level was here. It's just that here's a bit of inflation on this side. So just bring it. So if it gets to this level, I'm selling the market whenever it gets to this level. You see that? So let's say I sell here, and then I will see the momentum in my trade. You see. So for instance, this was not a momentum filled trade, you know, it was a slow trade. So it just it shows that it's not enough orders made in order to come and collect this liquidity on the downside. So after
Yeah.
then, I'm like, okay, that means that it's still changing character or forming a formation, and then the price goes down. So I'll end up closing my trade when I start to see reversal patterns and like start to see the market is telling me that it's reversing, which we'll get onto reversal patterns as we go as well. So once it came back up, it came to this level, I will also sell the market again. You see, I will also sell the market again. But then I think I only got onto this market when it was around about here, when it was picking up, because I thought I missed it at first, but then I saw it pick it up. So I was like, okay, still another opportunity. So the way it was also picking up was picking up in a trend-wise way. You see, so for here, it's an impulse action, and then it goes up. It comes down slow. It's a slow retracement. You see, so when it goes up again here, it went up slow as well to match this. So we can see that the character of this impulse movement is changing. It's no longer in an impulse mode. You see, so the impulse is changing. So it came up, and then there was another impulse. You see, another impulse. It came back, slowed down again. So when it went back up, it went up with the trend. So now it's starting to show you that the buying side is where the trend is now. So now it's changing character to the selling side. You see that? So then the levels came here, and then we sold NAS, and then we sold it until like here, until here. And then we sold it again at this point in order to meet that demand. You see? So yeah, that is how I would basically like deduce such a trade. But when we go into the 5-minute chart, it also gets different on how I look at it, which is like we'll also go into depth on the 5-minute chart and how I would see my execution points you see on the chart. So yeah, that's basically that for the trend line. We work to break the trend. So we track the trend, we see where the trend is going, see where the liquidity lies in the trend. And then we have to wait for the price to mitigate either at the discount or the supply. And then that's where we will take our execution. You see, so basically this analyzing strategy that I'm teaching it's called the SMC, which is the smart money concept.
SMC.
Yeah, SMC. So it's the smart money concept. It looks at where the smart money goes. You see where the smart money goes. Yeah, and you wanna go where the smart money goes, because that's where all the institutions and all the banks, that's where they move the market. Using this analyzing strategy, you'll be able to see basically where the banks are looking to go. Because the banks don't go to where the money is not, they go to where the money is. So this helps you see where the money is within the structure. You see, so when it comes to liquidity, liquidity can be used to also fill up gaps within the market. So the market will gap up, it leaves a huge gap. So we trade the gap. You see that we are trading the gap that is being created in the market. And then the trades are there to basically fill up those gaps. As you can see from this gap here until here. Now they're managing to fill up that gap. And you can see like in the time that they're doing it, it's a bit slow and tedious. That's because they just once the market was exhausted, it reached its exhaustion by the premium of the demand. They have to put in liquidity into the market in order to fill up those gaps. You see, and then once those gaps are filled up, the liquidity shows itself, and that's how we basically get see the entries for the impulse price action. So with that, basically gives you an idea of of the structure of the market, how the market is basically structured, you know, and there will also be a lot of structures. For example, you see this level here is a structure. They've created a structure on this level because the price keeps on rejecting here, so it's building a structure. So it's say so. We would see that the market is in full swing when it starts to break a structure. You see, so break of structure is also another sign that it's an ongoing movement. You see, so even if you were to catch the trade by the break of the structure, you know, it will still go because it will not retest that structure again as it's broken. You see, so on this time it bounced back, went back up. So it was validating the structure on these levels here. It's validating the structure. So once it entered the supply and it started having that momentum coming to break the trend, after it breaks the trend, it comes to break the structure. And then we know that the move is in full force. You see. So you also have to start identifying, you know, the market structure as well, and where are the structures made in the market, because we are looking at basically looking to break. We are breaking everything. We're breaking the trends, breaking the structure. You see, that is where our position is. That's where the most money lies in that instance. So yeah, you start to see the market structure properly. You'll start to also see it the more that you be trading and stuff. See, so also another very useful tool, you know, I don't want to get you using indicators, you know, and stuff like that, because those indicators can also be used to manipulate traders, you know, at the end of the day. So they can also be used to manipulate you. Yeah, they can give you false readings on those instruments and stuff. So the one main thing that I want you to rely on that's external is something that we call the Fibonacci levels. So Fibonacci levels basically they show us what level does what. You see. So let me just bring out the fib here. So you go to this. Also, we use TradingView to do our analysis. You see, I wouldn't advise you to use your broker's platform in order to analyze. It's always best to use TradingView because it's international, you know, and there's no manipulation in TradingView because it's you can't even trade directly off TradingView. It's just a platform to show you the market and all of that. So on our Fibonacci, we will take it from our highest point, from our premium to basically our premium to the two premiums. So let me just shift this here. Yeah. So you will see that there's one here, there's one, and then there's 0.8, 0.65, and then there's 0.5, 0.35, 0.2, and 0. So these are basically percentages within your trade. So like I said, in order to see our discount and our supply, we will need to use our Fibonacci. So once we spread the Fibonacci, we can see that, okay, the level where we marked our discount is at the 80%, you know, and the discount is usually no more than 20%. So yeah, we can validate that, okay, this is where our discount is, because we're having the Fibonacci spread us off that this is where the 80% level is. You see, this is where the 80, it can be on the 90, maybe sometimes here or here, but as long as it's not below 80, you know, that's That's
Yeah,
where
that
our
20% mark. Yeah.
yeah, so it has shown us where our discount is 0.2 to 0.1, the two difference. There's our next close level to the 0.2. So now we can say, yeah, okay, we have verified that this is where our discount is. You see that this is where our discount is. So these markets usually move, they will move from the 1%, it will move down to 0.65 to about your 60%. And then it will basically do a retracement because there's always a retracement. So retracement will be a basic pullback, a basic pullback or a swift correction in the direction of the market. So in this case, that we had the market come down. And then pin here, retrace. You see, it did a slight pullback. So this pullback here was to create the discount. You see that? Yeah. So for instance, most of the traders will start entering here because now they're seeing the sell. They're seeing that the sell is possible and it's happening right now. You see, and then most traders end up entering late, looking to see the sell already happen, and then be like, okay, I'm gonna dive into the sell. You see, and when you do that, they catching you on the retracement, and then they blow your account on the retracement. Instead of when you should have entered here before the sell even happens. Good traders enter before it happens, and then later on, when it happened, we were already in the trade. You see, we have no confusion.
Yeah.
So it came down and retraced, it created a discount. One thing also about after the market price leaves the discount, this is what we call, it enters into our psychological levels, which these levels are designed to play with your psychology. They're basically designed to test you. So this is the area where most people open and close trades. Some people will buy, some people will sell, and open it because they're not sure on what's going on in the market. Their psychology is tested. You see, this is why you want to avoid these levels here below the 80%. You can still trade these levels, you can, but it's gonna need a lot. It's gonna need a lot of patience and a lot on your psychology. You see, other than when you just enter by the premium and you just let the market go, it will never come back to the premium. If it left, and the market makers are like, yeah, this is our ride, it's gone. You see. Rose, listen, we just left with 10 minutes. I'm gonna stop this meeting and then open up another one. Just give me about 5 minutes.
Problem.
Yeah, 5 minutes for it to complete you. Then we'll jump back in.
Okay, cool.